Hello and welcome to Working Dad Trader. In today's video I wanted to talk about a really great book, which is this one, which is Money Master the Game by Tony Robbins. If you don't really know much about Tony Robbins, go and Google him. He is massive in the US and he's big across the world. He's a big inspirational, motivational speaker, does lots of big events and stuff. And he's done a book a few years ago now, all about money and sort of the basic steps of money and how to do really well. So it's really interesting. It's a lot to do with investing and what to look out for investing, especially if you're a beginner in the stock market. It's got some really great tips in here. Lots of simple things when you think about it to start with in the book. Tells you about the sort of simple things to look out for and to watch, which when you read it seems common sense, but I think a lot of us, even myself now, you forget about some of the certain things really which you should do. There's a lot of things like but it starts off in the book about basically getting yourself going. Make sure you start, basically plan your financial future. Obviously take into consideration if you've got debts and how to pay them off quickly, but then start planning it for your future. Don't just rely on if you've got like a government pension. In the UK we have a state pension, in America is it the 401k, people like that, stuff like that. It's just not going to be enough for people to live on. And he points out lots of simple facts that obviously generations are living longer and longer every year. So where before pensions were only designed really for you to live to about 80, now most people are living into their 90s and beyond. And where are we all going to live to in another 20-30 years possibly down the line? What's the average age going to be then with the advance in technologies and healthcare? You know, it could be more of near 100 before as an average age where people are living to, and a lot of people's financial forward planning into the future is not adequate enough for you to live on. And lots of people have company pensions, that they work pensions, but when they start maybe getting them at 65, you're probably going to run out of money before you're even 80. And this is what a lot of it is talking about and getting you to look into. You really need to think long term and how you're going to pay basically for your retirement. So there's some really great simple tips in there. So it's just simple things as well. If you haven't started yet, then the best time is to start. It's never too late to start investing into the market. One of the best ways to invest for your financial future, for your financial retirement, and making yourself more financially free, is to put your money into the stock market. And that's what it talks about in this book, that over history it's proven it's one of the best places to put your money. And he talks about, obviously, even if you can only afford just 10% of what you earn a month, try and get 10% out of your salary that you earn every month and put it into some type of investing vehicle into the stock market. He talks about ways you could save money. I mean, if you're someone who buys, he talks in the book, if you go to Starbucks every day before work or Costa Coffee and you buy a coffee for £5 or $5, if you could cut things like that out and put that $5 every week into an investing vehicle, and if you did that 5 days a week, that would be 25, so that could be £25 a week. Then it goes up to 50, and obviously it's nearly 100 then a month you're putting into some type of investing vehicle to invest into your future, and that amazingly will compound. And he talks about the magic of the compounding effect, as investors we all know the magic of compounding. It is amazing. It takes time. He talks about, obviously there's no quick fix to this. This is something where you invest now for basically your retirement, and this is why I got invested myself, is because I looked into my retirement and what was going to happen when my retirement plan was up, the state pension, and I just thought I'm probably going to be worse off financially in my retirement than I am now working. And when I was looking at the figures, like what I'd annually have incoming from the government pension, from the private pension, it was really quite a lot lower than what I'm actually earning now in a full-time job. So that was quite worrying and quite scary, and I was like thinking, well, surely retirement is about relaxing, you're trying to do some nice things, maybe, whatever you've got in your plans of retirement in your mind, maybe it's a world cruise, etc. I just couldn't afford to do these things, and I was thinking this is a worry, and we need to start looking at our financial futures and really planning long term. So that's how I got into investing, is thinking I need to do something, I need to take action now of my own financial retirement and start planning and making things happen. So a lot of that what goes into the book. He also goes on to about, obviously there's lots of funds out there to put your money in. It's better than just trying to buy single stocks with different funds, etc., then it takes a lot of the work away out of it, where you can just pick a fund and just pay into it every month through direct debits, just monthly installments, and then just forget about it. And you can just, if you're not really that interested in investing, but you just want a nice retirement, then that's what he's saying, something that you can only maybe visit once or twice a year, and you can generally forget about it, just keep the monthly payments going into it and let the compounding do its work. But he talks about all the different, obviously, active funds and mutual funds, and he talks about obviously watching fees. There's a lot of fees out there which are quite high, and they take a percentage of your money, and how that can really eat into your savings. So you really need to have a look at that, and I'll put a chart up now to give you some examples of that. Okay, as we can see from the chart, that for this example, if you had £1 million invested in the stock market and it gave you a yearly 8% return over a 30-year period, it shows the costs of what you would pay to a fund and how much this eats into your total. Obviously, if there's no cost at all, which is basically impossible, but if there was no cost to you putting your money in the stock market and you invested that £1 million at 8% return over 30 years, it would come in at £10,935,000, which is a fantastic sum of money. And then if you look at then, if suddenly you're paying a 1% charge over the period of the 30 years on this money to a fund or a mutual fund, an actively managed fund, if you're paying 1% cost, that suddenly then drops. Your money you only get out of it after 30 years is £7,612,000. You can see that's quite a big drop. And then if you're paying 2% on average over the 30-year period, that drops to £5,743,000, which from 0% down to 5 million, that's like you've lost half the money already just by paying a 2% charge over the 30 years. You can see how massively not just your interest compounds for your interest, for you to going up, but if you're paying a cost, that also works against you, and that compounds year after year against you as well. Obviously then on the last example was a 3% cost, which is really, really high, and that how that damages your overall money after 30 years. It drops down to 4,321,000, which is miles away from the 10 million that you would have with zero cost. So this is why costs and looking at how much you're paying really does eat into your final sum of money way into the future, and why you should really look at costs. Okay, and he also talks about the myths that sort of go with investing in the stock market. There's a lot of myths out there and things that get banded around which aren't true, and he sort of does a whole section on busting a lot of the myths. Some of them are like, you have to consider that 96% of actively managed fund managers don't consistently, over a long period, beat the S&P 500. 96%, and that's massive. Don't beat the S&P 500, and you have to take that into consideration when you're going with these fancy active fund managers who are promising the world. Quite often they're advertising return rates from a couple of years ago and the last couple of years, and they're not always 100% accurate, because obviously if you're paying in installments, monthly installments, then a lot of what they advertise would be a whole year return and not exactly when you're putting your money in, because obviously the market goes up and down. It doesn't just go up in a straight line, it goes up obviously in waves. So for argument's sake, when you put your first monthly money into a fund, it might be £100. The second month it might come down to £80. The third month it might be £140. So you're putting money in at different levels, so it's not a true comparison to what the returns are. So that's something else you need to think about and to watch out for. And he talks about, obviously, your broker or whoever you go to use will obviously tell you that they're doing their best for you and that you've got your best interest at heart, and it's not really true. They're doing what's best for them and their company that they represent. On certain things they might get better commissions, so to be aware of these type of things when investing, that it's not always in your best interest. Even with pension managers, etc., that are looking after your private pensions, they might well be trying to steer you into certain funds or invest your money in certain areas because it's better for them. They might get better commissions, etc., or it might be better for the company because there's higher fees, etc. So to look out for these type of things, there's lots of myths where the saying is that you need to take massive risk to get good rewards. Again, this is just not right, it's just false, and he talks about that in his book. You don't have to take massive risks, and in the book he interviews loads and loads of financial experts really, really top financial experts. And again, they take calculated risk where the odds are more in their favour when they invest their money. So they wouldn't just do a one-to-one risk. They would risk $1 with the potential of gaining 5 if they're correct. So, and that's how they would invest every time. So that they have, when they win big, and when they lose, they only lose $1. That type of thing. So yeah, and in this book, he also does a whole section where he basically interviews and sits down and chats with some of the investing masters, the best gurus out there in investing, the top good people, especially at the time of when he wrote this book. He sits down with some great names like John Bogle, who runs Vanguard, who came up with the whole idea of Vanguard making it cheaper for people to invest and offering a lot cheaper funds and the costs. He also talks to people like Warren Buffett, and obviously everyone knows Warren Buffett, and a lot of his ideas have already been done before and put out there. He talks to people like Paul Tudor Jones, a really top investor. A lot of what he comes out with and what the basic advice he gives is that when you're looking at stock or what investment you're in, if the 200 moving average on the charts is a really good gauge of whether you should be in the stock or not. And when you put that up, and if your stock is below your 200 moving average, you really need to get out of that stock. That is not a really good idea to be in that stock. And he's saying you should only really be investing in stocks that are above the 200 moving average, which is a really good basic point, and point that we, I guess, as investors sometimes forget about. He also talks about, obviously, like I've talked about, the risk reward. He only ever invests where the risk is 1 to 5. So every dollar he puts in, he's prepared to risk $1 to win 5. And that's the way he invests. If it's not a great reward, then he won't take the investment, he won't take the trade. So he will only ever look for his potential upside of being at least 5 to 1 on his risk. So if he's wrong half the time, he's only going to lose $1 every time he's wrong, where he would always win 5 every time he's right. So you can obviously add it up that he's going to make a lot more money that way in the long term, and he can afford to be wrong half the time in that example. And still be really, really profitable. So that's bits like that he talks about. There's also parts here with he interviews Charles Schwab, he talks to Mary Callahan, etc. Going back to obviously John Bogle, to do with fees and stuff when investing, they obviously bring up himself. John Bogle brings up how some of the fees are massive, where on Vanguard he's tried to make it affordable for people like us that don't have tons of money and not going to charge the earth. There's lots of funds out there where you're getting charged less than 0.5%, 0.10%, really cheap, where there's lots of other funds out there which are like 2%, and that can have a massive, massive difference on your over 30 years long-term money. It really eats into your money for your future, and that's what he talks about and how you should really be aware of that. A common theme through all the people, all the top investing masters, the gurus, a common thing they all talk about is diversification. That you really, really should spread your money across many assets and vehicles, and not just have it all in one area. And that brings us on to, he does a whole section on Ray Dalio. And Ray Dalio obviously is head of Bridgewater Associates, which is the biggest hedge fund out there. They have the most money under their company that they invest. And he does a big section chat with Ray Dalio, and then we go on to Ray Dalio talks about his advice for people like us, just normal investors, and talks about his all-weather portfolio.
So in this chart, Ray Dalio talks about there are potentially 4 seasons and which investments will perform better in each seasonal environment. So we look at if there's rising growth, then stocks, corporate bonds, commodities, gold, etc. do well. If there's falling growth, then your money should be in treasury bonds, inflation-linked bonds. And then if we've got rising inflation, commodities, gold, inflation-linked bonds do well. And if we have falling inflation, then normally treasury bonds and stocks come out top. So this is how we cover the whole 4 seasons. So in the next chart, it shows the breakdown of the percentage of where you should have your money invested to cover all those 4 seasons to keep you safe in all different conditions. So if we look, the biggest one is 40% in long-term US bonds, 30% in stocks, 15% in intermediate US bonds, 7.5% in commodities, and 7.5% in gold. The bonds are so high simply because Ray says that stocks and index stocks are 3% are 3 times more risky than bonds, and that should cover the risk factor against you and keep you generally safe. On Trading 212, I've used the pie option to put together my own Ray Dalio's all-weather portfolio. I've had to use UK ETFs because obviously I live in the UK, so I only generally have UK options. But if you live in the US, if you put it into Google, you'll be able to find the American equivalents to a lot of these ETFs I've put my own money into. So as we can see from the top, 40% of the money goes into SPDR Bloomberg Barclays 15 plus year gilt ETF, ticker symbol GLTL. Then secondly, it was 30% in stock, so I've gone with the Vanguard FTSE All World ETF, ticker symbol VWRL. And then 15% into intermediate bonds, so I've gone with the Vanguard UK Gilt ETF, which is VGOV ticker symbol. Then I have 7.5% in gold, so I've gone for the iShares Physical Gold, ticker symbol SGLN. And lastly, I've gone for 7.5% in Invesco Bloomberg Commodity ETF, ticker symbol CMOD. And that's the closest I could get to matching Ray Dalio's all-weather portfolio.
So I really could do like a whole video just on Ray Dalio's all-weather fund that he set up. And like I say, I've done a UK version, but the basic principle of it is where the S&P 500, etc. There's times throughout history, like recently with the COVID pandemic, that it's in the past it's had major drops of 20%. In 2008, had the massive crash in the market where it dropped 40%. When looking at the past performance of Ray Dalio's all-weather portfolio of all the different conditions, it takes away the big crashes. So the crashes in his portfolio are maybe only 10% crash instead of the 40%. So although it might not go up the really high amounts the S&P 500 goes up, it goes up a bit more steadily at around 7-8%. You don't get the massive drawdowns throughout, and if you're getting close to retirement, you really can't afford like a 40% crash one day because you didn't expect it with the market. So that's sort of why it's designed for all the different seasons within the stock market and what could possibly happen to your portfolio. So that's pretty much the book. The main points from the book is, like I say, it's a fantastic read. It's got some really good information, especially for beginners, really good basic information of, best time is to start now. Watch your fees, don't pay too much out in really expensive funds. Obviously, he's used examples of Vanguard, and Vanguards have some really, really cheap funds. Index trackers, just something nice and simple like an index tracker that tracks the S&P 500, where you're going to get some really great returns at very, very low cost to use, and that's why I use Vanguard as an example. And it's just simple things like diversifying your money, diversifying your portfolio into more than different areas, just to basically keep your portfolio balanced and safe, and so you can ride out the different phases throughout the market and generally get to your retirement and plan long term in the future and let the compounding magic do the work. Okay, so I hope you've enjoyed this video. Like I say, it's been quite long-winded, but I wanted to talk about this book. It is a really great book if you haven't read it. If you have read it, then obviously leave some comments and tell me what you enjoyed about it, and I hope to see you soon. Take care.